In this video, I'm going to discuss why passive income, such as income from buying and holding rental real estate, should not be taxed as an S corporation. And if you do this incorrectly, and trust me, many people do, you will actually pay more taxes on that passive income than you should be. So if this is your first time watching, my name is Navi Miraj. I'm a CPA that helps real estate professionals around the country save thousands of dollars in taxes. But that said, stick around because this video is really going to apply to almost every business out there. So let me just lay the foundation for you. So I recently created a video that talks about 4 reasons when you should not be taxed as an S corporation, right? And so as a quick recap, those reasons were number 1, you don't make enough profit in your business for the S corporation to make financial sense. The second reason was you have a W-2 job where you earn a high wage and you also have a profitable small business on the side. And when you mix those two together, it's not favorable to be taxed as an S corporation. The third reason was you reside in a city or state that taxes the S corporation, and that therefore eliminates the benefits of the S corp. And the fourth reason, which is the topic for this video, is that you participate in passive income activities such as rental real estate, and therefore that income shouldn't go through an S corporation. And so before we dive in, here's sort of a quick refresher on the basics, all right, to help you understand the contents of this video. But I'm telling you, stick around, especially if you plan on investing in rental real estate, because this is something you're going to want to know or need to know. So when you have profit from your active income business, so when I say active income, I mean you're in the day-to-day, and this is a business that's operational in nature. So you could be that real estate agent, that physician, or what have you. That business's profits are subject to 2 types of taxes. It's subject to self-employment taxes, and it's subject to income taxes at the federal and perhaps state level. So the self-employment taxes are paid at a rate of 15.3%, and your income tax is paid at a rate that varies depending on where you fall within the tax brackets, okay? Now, if you've been watching my videos, you know that you can deploy the S Corp strategy to save a bunch of money on the self-employment taxes, right? And so the S Corp strategy really doesn't have anything to do with the income tax, right? It's all about saving for the self-employment tax. And depending on the profits that you have from your active business, the S Corp strategy can save you upwards of $10,000 in taxes each and every year. So it's very, very powerful. Here's the problem though. There's so many videos and blog articles promoting the S corporation that everyone thinks that their business income should be taxed as an S corporation. What they don't tell you in those videos or those blog articles, either because they just simply don't know or they forget, is that they don't distinguish that the S corporation strategy is for your active income business. And I'm going to explain what I keep referring to when I say active and passive here in a second. So see, what happens is the IRS classifies your income as active or passive. And so I'm going to transition to the whiteboard here in a moment and explain this a little bit further. So if you run an operational business that I sort of alluded to earlier, then again, your income is subject to the 15.3% self-employment tax. And so when you're first getting started, you could be running that business through what's called a Schedule C in your tax return, or you could form the S Corp election to save money in self-employment tax, and you'll complete the 1120S, okay? So again, this is your real estate agent, physician, Amazon FBA, a yoga studio, whatever, right? Operational type business. You're in the day-to-day of the business activity, and you'll be subject to this sort of tax, right? But when you're involved in passive activities, such as rental real estate, that income is not subject to self-employment taxes. So you would avoid paying self-employment taxes to begin with for passive activities, right? So the mistake that you would make is you'd be putting your rental income over here and subjecting it to self-employment tax. You may accidentally put it on Schedule C or on the 1120S for your S corporation. Your passive activity is, again, not subject to the self-employment taxes. So it needs to be on a separate schedule, either called a Schedule E if you're just investing by yourself. That's likely where it's going to go. Or if you've invested in rental real estate with another person, then it'll likely go on a partnership tax return. And again, avoid the self-employment taxes altogether. I shouldn't really even say avoid the tax because it's not subject to it to begin with, right? So the point I want to make with this visualization is sort of a hard line here saying your active activity businesses will probably be on Schedule C or this S corporation and flow into your individual tax return, which is down here. Your passive activities will either be on Schedule E or on this partnership tax return, and it's going to flow into your individual tax return down here. You notice that this activity isn't on here, right? The income isn't flowing from here and then into this. It's flowing directly into your individual tax return. So be careful. I hear so many people use the term passive income incorrectly these days, and you need to make sure that you use the term properly as it relates to the IRS. Again, selling on Amazon FBA, income from YouTube, or if you're selling a course or something like that, these are not passive activities in the eyes of the IRS. The most common forms of passive income are, rental real estate, which I'm saying you purchase an investment property, you're the landlord, you have a tenant, and you earn that real estate income. Also, other types of passive income would be income from investments, such as dividends that you earn because you hold stock, or maybe you invested some capital into a business, so you're not involved in the day-to-day, but because you put that capital in that business, you get profits from that business each year. But again, you're not involved in the day-to-day. Someone else is running the business. So let me just say this. If you're watching this video and you're a little bit confused, that's okay. I understand, okay? Watch my other videos on my channel which dive into these topics further. They'll talk about, what is an LLC, what's an S corporation, why do people form S corporations, and that'll give you a better foundation, and then you could come back and watch this video again and it will make more sense. Let me just say this. If you didn't catch the 4 reasons on why you should not be taxed on S Corp, if you didn't catch that video and you're watching on YouTube, then I highly recommend watching that video. That video should pop up here shortly if you're watching on YouTube. If you're not watching on YouTube, then visit my website at navimirajcpa.com, and my entire library of videos is there for you to watch for free. So I hope that helps, or at least educates you on why you should not have passive income through or taxed as an S corporation. And if you learned something and receive value from this video, please consider subscribing and sharing this video with a fellow entrepreneur or real estate investor. Thanks for watching, and I'll see you in the next video.